If you're about to sell your real estate property in Canada and you're still confused about your tax implications, then stay tuned. You will get your answers in the next 3 minutes. What is up, YouTube? This is Yasin Nizami, your host, and today we are going to cover tax implications in a real estate transaction in Canada from a seller's perspective. In my last video, I covered it from the buyer's perspective. If you have not watched it, click here and you will see that as well. Now, I'm going to cover 3 different scenarios here. Number 1, if you're selling your primary residence. Number 2, if you're selling an assignment sale. And number 3, if you're selling an investment or rental property. Okay, let's talk about the number 1 scenario. So if you are owning your property and you've been using it as your primary residence, then when you sell it and whatever profits that you make, you're not supposed to pay tax on the profits, because CRA assumes that this is your primary residence and you're selling your primary residence to buy primary residence, and that's why you're not supposed to pay tax on the profits that come out of your your real estate transaction. Now let's consider capital gain tax scenario. So if you are selling your rental property, which has been your investment property for so many years, and now you're selling it to make some profits, the profits are subject to capital gain tax. Now, capital gain tax as of today in Canada is subject to 50% of your profits. So let's say you purchased a property for $500,000 and now you're selling it for $700,000. So you're making $200,000 profit out of this transaction. Now, only $100,000 are subject to capital gain tax because it is applied on the 50% of the gain. But the key here, guys, is these tax laws changes over time. So you have to keep up with the tax laws as well, because last time the tax law with regards to capital gain was changed in 2000. So before that, it was 75% on the total profit. So you have to make sure you keep up with these tax policies. Now let's talk about the third and final case, and this is a little bit complex because this includes assignment sale or flipping the property. In that case, I also made another video on assignment sale. So click here if you have not watched it to understand all the implications on that. Now, if you're selling an assignment sale property, which means you booked a property with your builder, let's say for $500,000, and now you're selling it for $700,000, but before closing it, right? So you're assigning your contract to somebody else, and that person will supposed to close the transaction with the builder, but you're making $200,000 profit out of that. That income is considered business income in accounting rules. Now, the business income is subject to 100% taxable. So unlike in capital gain, you're only supposed to pay tax on the 50% of the gain. In an assignment sale, you are supposed to pay tax on the 100% of the profit. This is subject to your marginal tax rate. So let's say your marginal tax rate is 40% or 50%, then half of that money will go in taxes. That's a huge difference as if you compare assignment sale case versus a rental property or investment property case, where you're only paying tax on the 50% of the gain, versus here you're paying tax on your total profits. That's it from me, guys. I hope this is helpful and you liked it. If you do, give me a thumbs up and hit the subscribe button so you will not miss any future videos, because I'll be publishing videos on these topics regularly. So the purpose of this channel is to educate my community with regards to real estate, in general, as well as some other topics that I will be covering from my engineering and sales and marketing background as well. So until my next video, take care.